like Bart Fisher, we So Richie had the votes. So Javier had an opportunity to be engaging, so we bailed out.
I got you. Good morning. This hearing in the Committee on Agriculture, Rural Economic Outlook, setting the stage for the next farm bill, come to order. Ask G.T. Thompson to open us with a prayer. G.T.
Thank you, Chairman. Please join me in prayer. Heavenly Father, we gather here today for this hearing. We ask for your blessings over these, the information that's going to be provided that will serve to lead us in policy to serve rural America, and as a result of strengthening rural America, serve all Americans. Lord, we just ask your presence be in this hearing. Lord, this morning we lift up and pray for those hardworking American families, the men, the women, the whole families that work so hard to provide us the food that we require, the materials for clothing and for building materials, for energy. We just ask that you protect them, be with them, and strengthen them in all ways. And I pray this in the name of my Savior, Jesus Christ. Amen.
Thank you, G.T. Looks at the crowd. There must be something going to happen this morning, so that's encouraging. Ordinarily, we kick things off every year with the Secretary of Agriculture offering testimony as one of our one and only witnesses. However, our new Secretary has not yet been confirmed. I've had a couple of visits with Sonny Perdue on a number of times, and I believe he's an excellent choice, and I hope that he can be confirmed in short order so that he may begin the important work as Secretary of Agriculture. This is our first full committee hearing of the 115th Congress, and Chairman Emeritus Frank Lucas will kick off a series of subcommittee hearings on February the 28th. This is also the first Farm Bill hearing. This is also the first Farm Bill hearing as we begin to develop the next Farm Bill. America's farmers and ranchers are facing very difficult times right now. This is something that the Federal Reserve, the Agricultural Food Policy Center, the Food and Agriculture Policy Research Institute, USDA, and even the Wall Street Journal agree upon. Farmers and ranchers have endured a 45% drop in net farm income over the last 3 years, the largest three-year drop since the Great Depression. The most recent ERS report now tells us that net farm income will be down again in 2017. Overall, ERS is forecasting a 50% drop in net farm income since 2013. It's hard for any of us to imagine our income being sliced in half. We're told that 1 in 10 farms are now highly or extremely leveraged. Nominal debt levels are at all-time highs, and real debt levels are approaching where they were prior to the 1980 farm financial crisis. Yes, interest rates are lower, and that certainly is a mitigating factor that differentiates our situation from the 1980s. But as a recent Wall Street Journal article stated, there's a real potential for a crisis in rural America. That's why I'm so eager for Governor Perdue to be confirmed. Even as we work to develop a new farm bill, the Secretary of Agriculture may well be called upon to help struggling farmers and ranchers. Let's all pray that a good crop and better prices this year will make that unnecessary. As we begin consideration of the next farm bill, current conditions in farm and ranch country must be front and center. But there are other important considerations as well. Chairman Lucas' strong admonition during the last farm bill debate that a safety net is supposed to be there to help farmers in bad times, not in good times, is one that Congress might better take to heart this go-around. Every hole in the current safety net that requires mending is the result of our not fully heeding that wisdom. Had we followed his counsel more wisely or closely, I doubt there would be anywhere near the current urgency in writing a new farm bill. That wisdom isn't just for the guy who's been around the block a few times in writing farm bills. It's the guy who actually farms and ranches. Another context we need to take into account when writing the next farm bill is this committee's contribution to deficit reduction. I'm hard-pressed to admit it, but the critics of the farm bill are absolutely right. We did not save the taxpayers the $23 billion that was promised. We saved them $100 billion. We saved more than 4 times what was promised under the last farm bill, and we achieved these savings despite a very severe and sharp downturn in farm economy. Because we asked during the last farm bill, when times were good, to cut twice before measuring once, in the upcoming farm bill debate, we will measure our requirements first and then determine what kind of a budget we'll need to meet those needs. I believe the majority of Americans recognize the need for a strong farm safety net. They see that what Mother Nature can do, and they strongly support crop insurance. They also see the effects of predatory trade practices on foreign countries that depress farm prices for our farmers and ranchers at the farm gate. For example, in a single year on just 3 crops, Chinese subsidies are said to be $100 billion over their WTO limit. That's what the entire safety net for all Americans farmers and ranchers costs over the life of the Farm Bill, plus more than half of another Farm Bill, and that's in 1 year. The President of the United States has stated that our farmers and ranchers deserve a good Farm Bill and one that is passed on time. This will require resources, bipartisanship, and unity in farm country. But it is also our duty to get this done, and we aim to do it. With that, I yield to my friend, the ranking member, for any opening comments that he might have. Colin?
Thank you, Mr. Chairman, and thank you for calling today's hearing, and thank the witnesses for being with us. As you said, this hearing is going to get the ball rolling on the committee's work to begin the next Farm Bill. So I'm going to keep my comments brief so we can get to our witnesses and questions. As you mentioned, ag, we've had some good years, but the last several years have been trending the wrong direction. And, we've seen significant reductions every year, year after year, here the last 3-4 years in net farm income across the country. But that is coming off of some pretty high levels. I was expecting that we were going to be facing some really significant problems this spring, winter, getting financing and so forth. Now, I don't know about the whole country, but in my part of the world, we had such tremendous yields and crops and harvest conditions that it offset the low prices. So we're not seeing the kind of pressure that I expected we'd be seeing at this point. But if these crop prices stay where they're at, and we get an average crop or a below average crop, we got big problems. So we got to keep that in mind as we write this bill. I agree with the chairman that we should write this bill based on what's needed for an agriculture, what's going to work for our producers, and not be driven by some outside budget force that somebody has come up with. We haven't received any direction from the Budget Committee yet. I hope that whatever we receive, it'll be something that'll be good. And I'll be working with the chairman to do what I can to make sure that, that we have the adequate resources, and at the same time, the areas that need some help, like dairy and cotton, can be addressed in this bill so that we've got a safety net that works for all of agriculture. So I thank the chair for holding today's hearing. Look forward to hearing from our witnesses.
Thank you, sir. The chair would request that other members submit their opening statements for the record so that our witnesses may begin their testimony and to ensure that there's ample time for our questions. I'd now like to introduce our witnesses at the table. First, we have Dr. Robert Johansen, Chief Economist, U.S. Department of Agriculture here in Washington, D.C. We have Dr. Nathan Kaufman, Assistant Vice President, Omaha Branch Executive, Omaha Branch, Federal Reserve Bank of Kansas City, Omaha, and Dr. Joe Outlaw, Professor and Extension Economist, Co-Director of the Agriculture Food Policy Center, Texas A&M University, Department of Ag Economics, College Station, Texas. I'd now like to recognize Ms. Hartzler to introduce our next two witnesses.
Well, thank you, Mr. Chairman. I'm very honored and pleased to introduce two of our ag economists from Missouri, from the university, and I'm really proud of them. We have Dr. Scott Brown, who's an assistant extension professor at the University of Missouri's Ag Econ Department, and the MU State Extension Agricultural Economist. And Scott has worked with U.S. Congress over the past 2 decades. You may have seen him before. He works with us on dairy and livestock policies, and like myself, Scott grew up on a diversified row crop and livestock farm in Missouri. Then we have Dr. Pat Westhoff. He's the director of FAPRI, the Food and Agricultural Policy Research Institute at the University of Missouri. He's a native of Manchester, Iowa, where he grew up on a family dairy farm. And from 1992 to 96, he served as an economist for the Senate Ag Committee, and he joined FAPRI in 96 and has worked on a range of projects not only in our country, but also in Europe, Africa, and Latin America. So in Missouri, we are very proud of both of these experts, and I appreciate them coming today and sharing their expertise with us. So thank you, Mr. Chairman, for allowing me to introduce them.
Thank you, gentlewoman. Dr. Johansen, you are recognized for 5 minutes.
Mr. Chairman and members of the committee, thank you for inviting me here today to discuss the state of the agriculture and the rural economy in the United States. I have submitted a detailed statement for the record, so I will direct my comments towards the broader picture of the U.S. ag economy, focusing on 2 main themes. I'm sure our distinguished panelists here will be able to follow me and hopefully provide more details on those. But first, I want to talk, what does the current farm income situation look like right now? Based on the data that we've been collecting at USDA. Second, what is USDA's outlook for prices and production in 2017 and prospects for growth in the future? First, farm income is expected to remain relatively flat in 2017. Credit availability continues to tighten, but continued resilience in the farm sector is also expected. Reversing the direction of the last 2 years, we do expect to see net cash income rise slightly from 2016. However, as you mentioned, net farm income, a broader measure, is forecast to fall slightly. I'll just point out that both changes in those measures stand in the single digits and are far less dramatic than the declines of the past 3 years. And we know that much can happen during the year, as Congressman Peterson pointed out. Recall, last year at this time, USDA had projected net farm income at $54.8 billion for 2016. Now we are estimating incomes in 2016 higher by almost 25% at $68.3 billion, as producers found additional ways to lower production expenses. And while the aggregate debt-to-asset ratio continues to rise, those levels in an aggregate measure still remain low by historical standards, supported by continued strength in farmland values. Of course, that story varies by type of farm and farmer. Looking at farm business operations, which account for more than 90% of production and about 40% of farms, approximately 11% of crop farms and about 10% of livestock operations have debt-to-asset ratios above 40%, putting them in the highly or very, very highly leveraged category. Now, those levels have been trending upwards since 2012, but remain below the peak we saw as recently as 2002, which was a low point for farm income. Currently, we see that about 1 in 5 farms specializing in wheat, cotton, poultry, and hogs have debt-to-asset ratios above 40%. We also know that young farmers and those that rent more of their land typically have higher debt-to-asset ratios. For example, operators 34 years old and younger had debt-to-asset ratios in 2015 of 28%, compared to 16% for those aged 45 to 54 and only 11.5% for those aged 55 to 64. We've seen land values and cash rents decline last year, and evidence suggests that they will fall again in 2017, but the rate of decline remains relatively slow. Recent data from the Federal Reserve Banks indicated year-over-year declines of between 1% and 8% in agricultural land values across the 7th, 8th, and 10th districts, with differences depending on type of land and state. Cash rents and share rents are showing more varied declines, but are also adjusting downwards. Still, we know many producers face difficulties with low commodity prices, as operating costs have not fallen as far or as quickly as have prices. Some producers may be able to rely on capital reserves, but for many, particularly those new to farming, that option is no longer an option. Credit availability at commercial banks has tightened, although we've seen delinquencies rise only slightly. I'm sure Dr. Kaufman will talk about this. With interest rates still low and farmland values declining relatively slowly, farm debt presents a lower risk to the sector than it did in the 1980s. Current data suggests interest payments on current debt relative to net farm income is about 20%, whereas in 1985 it exceeded 60%. Farm programs will continue to provide assistance to producers. For example, USDA's farm loan demand increased markedly last year, reaching record high obligations of $6.3 billion, including record assistance to beginning and historically underserved farmers and ranchers. Demand for USDA loans continues to match last year's pace. Combined payments under the agricultural risk coverage and price loss coverage programs are projected to increase in calendar year 2017 before tapering off in 2018 and 2019. Participation in the crop insurance programs remains high, with nearly 90% of major crops covered and steady growth in specialty crop participation. Liabilities are likely to grow and remain above $100 billion. In the near term, global economic growth is projected to remain slow, and consequently it is likely the dollar will remain strong. In addition, another year of record global crop production is added to large global stocks. While we expect global demand to grow, stocks relative to use are likely to remain high compared to recent history, which will continue to pressure commodity prices. Export values, though, are expected to grow into 2017 and over the next 10 years. Currently, we project in 2017 a 3.3% increase over overall values in 2016 to a total of $134 billion. To sum up, our long-run expectations for global agriculture reflect an assumption of steady world economic growth and continued growth in global demand, factors that combine to support longer-run increases in consumption, trade, and prices over the long run. We still see land values remaining relatively high, interest rates and energy prices remain relatively low. The severe drought in California and more recently in the Southeast appear to be significantly diminished, and our expectations of the new crop year farm programs and impacts on the farm economy discussed today, as I'll note, were developed in large part several months ago. We're updating our assumptions. We'll be publishing our new estimates and our first balance sheets for the 2017-18 crop year at the forum in a week. Mr. Chairman, to conclude, I want to take a moment to thank you again for agreeing to participate at the forum next week. That concludes my opening statements, and I'm happy to answer questions for right now or for the record.
Thank you. Dr. Coppin, 5 minutes.
Thank you, Mr. Chairman, members of the committee. It's an honor to be here this morning, so I very much appreciate the invitation. My name is Nathan Kaufman. I'm an economist and Omaha branch executive with the Federal Reserve Bank of Kansas City, a regional reserve bank that has long devoted significant attention to U.S. agriculture. In my role, I lead several efforts to track the agricultural and rural economy, including a regional agricultural credit survey and the Federal Reserve System's Agricultural Finance Data Book, which is a national survey of agricultural lending activity at commercial banks. Our bank remains committed to including perspectives from rural America in discussions on the national economy, and I'm here to share with you this morning recent developments in the U.S. farm sector. My comments will largely focus on the current environment in agricultural credit markets and farm finances. Before I begin, let me emphasize that my statement represents my view only and is not necessarily that of the Federal Reserve System or any of its representatives. The outlook for the U.S. farm economy remains subdued, and financial stress has increased modestly for many producers over the past year. Following several years of historically high farm income prior to 2014, which was primarily driven by strong demand for agricultural products and high commodity prices, farm income has dropped significantly and is expected to remain low in the near future. The low price of major agricultural commodities has remained a primary driver of the weakness in U.S. farm income, despite some reduction in farm production expenses. Put simply, the downturn in the agricultural economy appears to be continuing into a fourth consecutive year. According to our bank's quarterly survey, farm income has declined from previous year levels in every quarter since mid-2013. Surveys conducted by other regional Federal Reserve banks have shown a similar trend of declining farm income, reduced cash flow, and weakening agricultural credit conditions. The prolonged downturn in the U.S. agricultural economy has led to gradual but steady increases in financial stress among agricultural borrowers. Our data show that working capital has decreased modestly each of the past 3 years, and the rate at which farm loans are repaid has declined in every quarter since mid-2013. Alongside reduced cash flow and depletion of working capital, demand for farm loans has increased, particularly for short-term operating loans. The Federal Reserve's Agricultural Finance Data Book, included with my written testimony, shows that nearly 60% of new farm loans originated at commercial banks are used to finance operating expenses. Moreover, data from commercial banks and the Farm Credit System both show steady increases in outstanding farm debt in each of the past 4 years, which, to reiterate, has been a period of declining farm income. Recent data from commercial banks suggests the pace of debt accumulation may be slowing. However, the debt-to-asset ratio in the farm sector, which is a key measure of the financial health of farm borrowers, has increased modestly in each of the past 4 years, according to USDA, and is projected to increase further in 2017. A steady decline in farmland values has also contributed to a gradual increase in financial stress and a higher debt-to-asset ratio. Regional Federal Reserve surveys show that the average value of high-quality cropland has declined by 10 to 20% since 2013 in states with a high concentration of crop production. Although the downturn in the farm economy has persisted, some indicators are more positive. Strong crop yields in 2016 led to stronger cash flow last year than what was initially anticipated, and cash income is projected to remain steady in 2017. Moreover, the debt-to-asset ratio of the farm sector, while rising, is still historically low, and the persistent decline in farmland values has in fact been quite modest thus far. The relative strength in farmland values has likely shielded the farm economy from potentially more severe financial stress, since farmland accounts for more than 80% of the value of farm sector assets and is an important source of collateral for other farm loans. The strength in land values has given agricultural lenders some opportunities to work with borrowers by restructuring loans and requesting additional collateral in response to heightened risk in their loan portfolios. To briefly summarize, agricultural credit conditions have weakened somewhat over the past year, and financial stress in the U.S. farm sector appears to have increased modestly as commodity prices and farm income have remained low. However, a farm crisis on the scale of the 1980s still does not appear imminent, as farm loan delinquency rates remain low and credit availability has generally remained strong. But if farm income remains persistently low, if farmland values continue to decline, and if debt continues to rise, all of which have been trends in recent years, it is possible that key indicators of financial stress, such as debt-to-asset ratios, could rise to levels similar to the 1980s over a longer time horizon. This concludes my formal remarks, and I'd be happy to take questions at the appropriate time. Thank you.
Thank you, Dr. Kaufman. Dr. Atlaw, 5 minutes.
Chairman Conaway, Ranking Member Peterson, and members of the committee, thank you for the opportunity to testify on behalf of the Agriculture and Food Policy Center at Texas A&M University. As many of you know, our primary focus has been on analyzing the likely consequence of policy changes at the farm level with our one-of-a-kind data set of information that we collect from commercial farmers and ranchers located across the United States. For over 30 years, we have worked with the agriculture committees, providing members and committee staff objective research regarding the potential farm-level effects of agricultural policy changes. Working closely with commercial producers has provided our group with a unique perspective on agricultural policy. I was specifically asked to provide my perspective today about the conditions for crop agriculture. In 1983, we began collecting information from panels of 4 to 6 farmers or ranchers that make up what we call representative farms located in the primary production regions of the United States for the major agricultural commodities. The results I'm going to discuss today focus on the financial condition at the end of 2016 crop year for 64 representative crop farms located in 20 states. Figure 1 included in my testimony indicates each farm's location, type of farm, and the total number of acres on the farm. We have developed a color coding system to provide a quick way of showing how the farms are doing. Each farm is evaluated based on 1, their ability to cash flow, and 2, their ability to maintain equity. If a farm has less than a 25% chance of not cash flowing or losing equity, then it is coded green. Yellow farms have between a 25 and 50% chance, while red farms have a greater than 50% chance of not cash flowing and losing equity. Figures 2 through 5 provided in the testimony provide maps of all the farms along with our rating of their financial condition at the end of the 2016 crop year. To be blunt, these results are bad with very little hope of recovery on the horizon given current price forecasts by FAPRI and USDA. 49 of 64 farms are in moderate or poor financial condition. Specifically, 17 of 23 feed grain farms, 9 of 11 wheat farms, 11 of 15 cotton farms, and 12 of 15 rice farms in the period in moderate or poor financial condition. The overwhelming majority of the farms in 2016 with a high likelihood of serious cash flow shortfalls. On the other hand, the probability of large equity losses is much lower across all farms. We contact our individual representative farm members when we need their feedback on important issues. For this hearing, we specifically asked them about their financial situation now relative to last year at this time. How has their equity positions changed since 2013, which was the high of the market, and why, and their overall observations of the current financial environment. Below are a few generalizations I can make after reviewing all of the responses. There was only one farmer that reported making a profit on the 2016 crop. Corn farmers from North Dakota and Iowa, as well as cotton farmers from West Texas, indicated the only reason they broke even in 2016 were record yields. Generally, all the rest indicated that 2016 was a lost year where they had to roll operating notes forward or draw from reserves to pay off operating loans. Most indicated their equity positions were down at least 20% from 2013. Land values have declined some, however, many cited a substantial decline in equipment values as a major cause of lower equity, in addition to having to borrow more. Their overall observations about the current financial environment were very discouraging, to say the least. They all indicated there's nothing else left to cut. They worry about the future of farming for younger farmers who are likely carrying more debt as they try to build their operations. In summary, I want to offer a few points for your consideration. First, the producer safety net contained in the 2014 Farm Bill has worked as intended for all crop farms except cotton. The combination of federal crop insurance and Title I commodity programs has helped the overwhelmingly majority of U.S. producers stay in business through some very difficult times. While the farmers we met with all expressed concern for the future, many indicated there wouldn't be a future without crop insurance protecting against weather problems and the PLC and ARC programs protecting against low prices and incomes. The lone exception is cotton, as their stacks program has not provided the protection producers were hoping for. Not having Title I programs to protect from the sustained drop in cotton prices has caused severe financial difficulties only overcome by occasional record yields. Second, according to USDA, in the 3 years since the 2014 Farm Bill was passed, crop cash receipts have fallen $23.7 billion. During that time, Title I payments to crop farmers have totaled $13.2 billion, or a little more than one-half of the estimated loss in crop receipts. In no way are commodity payments making producers whole. And finally, it seems like nearly every month there is another report issued from interest groups who want to dismantle the producer safety net, often saying programs are too lucrative. Not only are the programs not too lucrative, but there is a growing need to provide additional funding as adverse economic conditions are expected to continue. Mr. Chairman, that completes my statement.
Thank you, Dr. Westhoff.
Mr. Chairman and members of the committee, thank you very much. At the University of Missouri. For more than 30 years, FAPRI has provided analysis to Congress and the public to help people make more informed decisions. We do our best to provide objective analysis and do not make policy recommendations. My comments today are my own and do not necessarily represent the views of the University of Missouri or of the agencies that fund our research. For a wide range of agricultural commodities, prices now are far lower than they were a few years ago. Many factors have contributed to this downturn, but it makes sense to begin on the supply side of the picture. Since 2002, world production of corn, wheat, rice, and soybeans has increased by a remarkable 49%. Most of that increase in production was needed to keep up with population growth, expanding livestock production in China, and biofuel production in the United States and other countries. However, in the 4 years since the drought of 2012, global grain and oilseed yields have exceeded the long-term trend, and production has outpaced consumption. The result has been a sharp increase in carryover stocks for those major commodities, and downward pressure on commodity prices. Of course, the current situation is not just a supply story. Slower expansion of biofuel production, a strong dollar, and policies in other countries are just some of the demand-side factors that have contributed to lower farm commodity prices. Our institute is in the process of preparing its new 10-year baseline projections for the farm economy. We use USDA historical data, economic models, and expert analysis to project how commodity markets might evolve if current policies remain in place. The remainder of my comments are based on point estimates from this new baseline, what the world might look like under average weather and market conditions. Net farm income averaged $101 billion per year between 2010 and 2014, as shown in Table 1. Relative to the previous 5 years, higher prices resulted in dramatic increases in both crop and livestock receipts that outpaced a sharp increase in production expenses. Commodity prices are now far below their peak, and both crop receipts and net farm income have declined. For the 2015 to 2019 period, we project that net farm income will average $74 billion per year, down by more than 1/4 from the previous 5 years. Correcting for inflation, in fact, real net farm income is now less than it was between 2005 and 2009. Looking ahead, we project a modest increase in crop prices and cash receipts that contributes to a small increase in nominal net farm income in 2018 and beyond. However, projected real net farm income, correcting for inflation, remains below the 2015 level through 2025. Higher land values caused the value of farm assets to nearly double between 2004 and 2014. In 2016, however, USDA reported a slight reduction in farm real estate values and total farm assets. Looking ahead, we project further reductions in real estate values. Cropland rental rates are falling in some parts of the country in response to weaker crop returns, and the prospect of higher interest rates could also put pressure on farmland values. Farm debt increased sharply as some farmers borrowed to buy more expensive farmland and machinery and to cover rising operating costs. Lower returns are making it harder for farmers to service debt, and which continues to rise in the face of lower farm income and asset values. The result is an increase in farm debt to asset ratios, which increased from about 12% between 2010 and 2014 to about 14% in 2017, and to projected levels that are a couple points higher by the time you get a few years in the future. The projected debt to asset ratio remains far below the 1985 peak of 22% during the farm financial crisis, and interest rates are also far lower than they were at that time. Nevertheless, the trend of a rising debt to asset ratio is a serious concern. and many highly leveraged borrowers may find it increasingly difficult to service debt. In my written statement, there is a discussion of the outlook for particular crops. In brief, returns for most crops are far below the peak levels and are expected to remain near those levels over the next decade. My final comments. The figures presented here are just one way the future might unfold. In reality, the weather is rarely average. Policies change, and other surprises will happen. A drought could push prices higher, a trade dispute could reduce exports, or a change in interest rate policy could make it harder for farmers to service debt. Baseline projections are not a crystal ball of what will happen, but rather a useful benchmark that can be used to evaluate what-if scenarios. My colleagues and I stand ready to examine policy alternatives and other options that may be useful to you. I'd be happy to take any questions.
Thank you, Doctor. Dr. Brown, your 5 minutes.
Chairman Conaway, Ranking Member Peterson, and members of the committee, thank you for the opportunity to discuss the rural economic outlook. I am the University of Missouri State Agricultural Extension economist and have worked extensively on federal dairy policy. The Missouri rural economy has changed quickly, but the change is not spread evenly, as ARMS data shows that the debt-to-asset ratio of all Missouri farms increased by just 1.8% from 2012 to 2015. Yet in the 35 to 44 age category, it nearly doubled. Lower 2016 cattle, milk, and hog prices resulted in livestock industries facing financial headwinds, which continue. Only dairy is anticipating higher prices this year. A bright spot is that feed costs are lower. ERS reports 2014 purchase feed expenses reached $63.7 billion, but are projected to fall to $57.9 this year. After reaching a 2014 record level of $24, the milk price declined to $16 last year. Two factors drove this decline. First, the value of U.S. dairy exports declined from a 2014 record of $9.5 billion to $7.1 billion in 2016. Second, milk production expanded for the 7th consecutive year, and dairy cow inventory increased by 48,000 head. It has become increasingly difficult to reduce milk supplies even when financially stressed. Since 2000, annual milk production has declined twice, while it fell 5 times over the 1986 to 1999 period. Given the 2016 economic dairy industry downturn, there is growing concern that the margin protection program is not providing a strong enough safety net. It is extremely difficult to construct a stronger safety net program for dairy while reducing federal spending. Dairy cash receipts have remained volatile from $24.3 billion in 2009 to $49.3 in 2014. They retreated to $34.2 billion last year, but that's still $10 billion above the 2009 level. CBO currently estimates annual average dairy outlays as $79 million over the FY17 to FY27 period. Identifying a dairy safety net that can moderate the large change in cash receipts and yet show an average cost of $79 million is a large challenge. There's a high correlation between government expenditures and the effectiveness of the safety net. Changes to MPP or other alternatives will likely result in a more effective safety net only if these estimated costs rise. We are entering our 3rd full year of MPP, and participation in higher margin coverage levels have fallen. In 2016, 140 billion pounds of production history was enrolled in the $4 coverage level. No region of the country has shown an appetite for buy-up beyond $4. 2017 MPP data will show even more production history has shifted to $4. The $4 catastrophic coverage does show state-level differences. California and Idaho have more than 80% of their 2016 milk production levels covered while at the $4 level, while Minnesota and Wisconsin have about 60% of 2016 milk production covered. MPP participation is much lower than originally estimated in 2014. During MPP debate, many assumed that 70% of milk production would sign up for 650 coverage. The 2016 MPP data shows that only 2% of 2016 milk production was signed up. The MPP experience has been very different, especially the level of government spending. In May-June 2016, the largest payment period since enactment, MPP spent less than $12 million. CBO estimated MPP spending at $912 million over the FY14 to 23 period with 2014 Farm Bill passage. Other estimates, even larger, top $2.5 billion. My analysis suggested that at a 650 margin level, nearly 80% of the outcomes had no MPP payments, yet the remaining 20% of the time when payments occurred, they were large enough to offset the times without a payment. Historical data would suggest similar findings. Projected feed costs have moved much lower than when MPP became law. The 2013 CBO baseline corn prices averaged $4.59 over the 13 to 23 marketing years, while CBO's current baseline has the average corn price over the 17 to 27 marketing years at $3.79. Declining feed costs reduce MPP program costs. The decline in corn prices and the different CBO baselines provide nearly an offset that would return MPP feed coefficients to their original proposed levels. The 2016 MPP experience left many dairy farmers disenchanted. The reduction in feed costs resulted in the MPP margin falling less than milk prices declined. Given the inelastic nature of dairy supply and demand, the cost of the dairy program can go from zero to billions of dollars quickly. Finding ways to spread risk across federal policy and market risk tools may be the balance that provides a better safety net. Margin risk management is different and requires a change in perspective from program return maximization to risk management. Mr. Chairman, thank you for the opportunity to discuss the issues facing livestock and dairy industries. I look forward to working with the committee to find a better safety net for dairy producers in the 2018 Farm Bill.
Well, thank you, gentlemen. The chair would remind members they will be recognized for questioning in order of seniority for members who were here at the start of the hearing. After that, members will be recognized in order of arrival. I appreciate the members' understanding. I will be strict on the 5-minute clock in respect to the fact we've got most all of us are here today. I'll ask our witnesses when the red light goes on, finish your thought, and then any other comments you would like to make, we'll take those for the record. But I appreciate the members being respectful to allow us all to get through this. So I'll now recognize myself for 5 minutes. I don't like the lyrics to your song, but you're apparently all singing off the exact same sheet of paper. If the mid-'80s are the gold standard of crisis in production agriculture, I didn't hear anybody say that that's where we are today. But how will we recognize that, and what would be your thoughts on, with declining price or prices flat, collateral value down both in equipment and land, all those things that all of you talked about? None of that was particularly rosy in terms of the immediate next 4 or 5 years. Could you each of you quickly just say what you thought the risks are of us moving into something that would approach the 80 level wreck that folks tried to live through? Dr. Johansson?
Thank you, Mr. Chairman. As you mentioned, none of us at least are painting the same picture as we saw in the 80 situation. Things I would be looking for, continue to look for in the data would be rising interest rates faster than we expect, pressuring interest payments as well as declining land values. Repayment delinquencies, they've been trending upward, but they still remain relatively slow. So if we see those continue or increase, that would be increasing cause for concern. And similarly, if we see a rapid drop in cash rents, that's likely to bring land values down. That's likely to bring the asset base down that is underlying the relatively strong debt-to-asset ratio we're seeing right now.
Thank you, Mr. Chairman. In the 1980s, I would say that it was a liquidity crisis that turned into a solvency crisis. We do have some of those concerns around liquidity today, but as I noted in my statement, debt-to-asset ratios remain relatively low and historically low. If we were to see more of a decline in land values than what we've seen so far, that would be an additional risk to the farm sector and to solvency, where we haven't seen those kinds of bankruptcies yet. So I would list that as one. We've seen some pretty significant declines in commodity prices and in farm income, but they haven't necessarily been coupled with a commensurate decline in land values of the same magnitude.
We're all about to say the same thing. Essentially, the only thing I would like to add is that from our research, they're exactly right. The cash flow situation is really bad. The equity situation isn't quite as bad, but we can see it really on the horizon. If cash flows continue to struggle, then they're going to lose equity.
Yes, the same song sheet. Yes, we do expect to see continued increases in debt-to-asset ratios, but starting from a very low base. What would really be concerning, of course, if you had a big increase in interest rates, that could simultaneously increase interest costs and put further downward pressure on land values.
Trying to add something different, I will say one of the issues that we see relative to the 1980s, which I remember very well, is that I still see a lot of farmers today, maybe older in age, that are looking for opportunities to purchase land. So I don't think it's the same across-the-board dire situation that we would have seen in the 1980s. And I remind us that, yes, calf prices for my Missouri producers were $3 a pound plus in early 2015 are now setting more like $1.50 a pound, so they've fallen in half. But that's a far cry from where we were in, let's say, 2008, when we might have talked sub $1 cattle prices.
So we're going to be writing a farm bill that will become effective October 1st of 18, and that would go over that next 5-year time frame, so about 7 years plus. Anybody have any kind of a horror story that you think that we would be in those kind of circumstances within that 7-year period?
The only horror story I could say is that producers are going to need every bit of the safety net that you can provide them. And I know that with resources being as tight as they seem to be up here, you're going to have to be really imaginative to figure out how to spread that money as far as you can. Dr.
Kaufman, let me ask you real quickly. You study the debt of farms, both the official debt. Do your numbers capture all the unofficial debt, folks using credit cards and other things that might not be dedicated to agriculture specifically to try to keep their deals afloat? Are you capturing, are your numbers capturing all the debt that would be associated with it?
The numbers that I reported did refer specifically to commercial banks and the farm credit system, which account for about 80% of farm debt that's out there. It's true, though, that there has been a bit of an increase over time in debt coming from input suppliers. So that is something that USDA and others seek to capture in their measures and goes into the debt-to-asset ratios. But the data on that is a little bit harder to come by as they're not necessarily regulated entities.
All right. So the debt-to-equity ratios wouldn't be any better if you captured that debt?
Either of those is measuring debt holistically as we're trying to capture all of those main categories.
All right, Mr. Peterson, 5 minutes.
Thank you, Mr. Chairman, and thank all of you for your testimony. You know, I think for myself, you know, what I'm looking at in this next farm bill is looking at stuff that needs to get done. And cotton, I don't know a whole lot about cotton, but I support getting it. I support getting it back into Title I. Thank you. And helping the chairman get that program to work. I also, one of my other things I'd like to see us do is get the CRP back up to 35, 40 million acres, which is where it should be. It needs to be streamlined and some other things. And the other thing is the milk situation. And you know, CBO was so far off, and I guess we were too, in terms of how this was going to work. Now we're still struggling with the situation where CBO, when we get these numbers back, when we're looking at alternatives, are just completely out to lunch, in my opinion. You know, so I don't know how we're going to ever fix this thing if we can't get CBO to understand what's going on in the real world. Maybe we need to send them out and talk to some of these dairy farmers that I've been talking to. Maybe that'll wake them up. But, you know, how we're going to fix this with the numbers that I'm seeing, it just looks like maybe we can do something with the cat coverage and raise that from 4 to 5. Probably wouldn't be too expensive. Would that cost very much, Dr. Brown, if we did that, you think?
Given our experience the last few years, I'd have to think $5 catastrophic coverage would have a fairly small price tag because we have not seen MPP margins below $5 since we enacted the 2014 Farm Bill.
And they're probably not forecast either out in the future.
Not at this point in time,
Well,
especially given how low crop prices
And
are.
what I'm worried about is with these prices, when they collapse, and they will, we're not going to have people in the program. We're not going to have the coverage for this. And the dairy farmers that I'm talking to, they think we're going to bail them out. And I don't know, I don't see that happening, you know. So somehow or another we got to fine tune this thing, figure out how to get people to participate. But I have to tell you, talking to my producers and other producers around the country, I think it's going to be a tough sell because they look at this thing and if I'm not going to get any money out of this, then I'm not going to do it. And we had other people that went and bought coverage and didn't get paid and come up to me and said, I'm never going to go back in that program again, I don't care what. I'm not even going to buy catastrophic coverage. I said, well, what are you going to do if this thing goes to heck? Well, whatever, you know. I mean, it's a big problem. So The only thing I can see, if we can't get CBO straightened out, the only thing I can see is we might be able to do something for the 4 million pounds and below, and maybe the cat coverage. And beyond that, I'm not sure there's anything we can do. So one of the other questions that I had, though, is that I think one of the things that's happening is people are looking at this 1 year at a time. They're talking to people and say, well, I'm not going to get any money, so I'm not going to sign up. Would it be better if we had a 5-year situation, if we had a little better safety net, and we made them make a decision for 5 years? Would we get more people participating, do you think, than we are under the current situation? And does it make sense to look at that?
It would seem when you're doing it year by year, you give folks the chance to move around a lot, and sometimes they don't make the best decision. We know milk prices move so quickly that the choice they make turns out to be the wrong one. If you have them in for a longer period of time, perhaps they rethink that strategy and would pick a higher level of coverage.
Are they going to have to get burned before they finally wake up and use this?
I think given what we have today, yes, it's going to take a situation where payments would have occurred to really get folks to understand how the program operates.
And why is milk, I mean, it's always been a problem, but it seems like it's more of a problem now. When dairy farmers, when the prices go down, they produce more milk so they can cover their overhead. When the prices go up, they produce more milk. So do we have more fixed cost in the system now, more people that have come into dairy and they've got to have a certain amount of cash flow to make things work? Is that what's driving this production that keeps going up even though the prices are going down?
I think when you look at the structure of the industry today, and we have a lot of very large dairy operations that are in place, even if the current operators were to go out of business, what happens to those large operations? Someone buys them for cents on a dollar and produces milk. So we can't get milk out of the system as easily as maybe occurred 10 or 15 years ago.
Well, thank you, Dr. Brown, and we look forward to working to figure out how we can make this work. Thank you.
Jim Yosback, GT, 5 minutes.
Thank you, Chairman. Thanks to all members of the panel for being here as we kind of certainly look at some forecasts for the rural economy. I actually believe that's one of the, for me personally, serving on this committee, it's about making sure that we have a strong rural economy. And specifically the largest commodity, and I really appreciate the insight that many of you offered on the largest commodity in Pennsylvania, which is our dairy industry, which is hurting dramatically. I was very proud to be asked by Pennsylvania Agriculture Secretary Russell Redding to join a appropriately named a dairy development work group to be able to look, parallel the work that we do here, but at a state level, and we have dairy farmers and co-ops and real diverse stakeholders sitting at the table trying to look at what are the local, state, and federal issues impacting the challenging economics of our dairy farm families today. And we don't have we have some of the larger farms that you made reference to, but in Pennsylvania it's largely smaller farms, and but a lot of them. And so, Dr. Brown, I wanted to just kind of explore one potential fix that's been identified on dairy relates to how producer feed costs are calculated. Obviously, we kind of went some different rounds on this with the Farm Bill. Specifically, it's my understanding that during the drafting of the current Farm Bill that we have, which by and large actually I think was very successful. But when it came to the feed factor for corn, soybean meal, and alfalfa, they were reduced by 10% from those originally proposed in consultation with the dairy producers, nutritionists, and economists. Do you believe that restoring the feed factor to their original proposed levels would help the program reflect the needs of the dairy farmers and really allow the MPP to be able to be utilized, to have a return on investment for those who buy into that risk management program?
Well, as you recall, during the 2014 Farm Bill debate, and this would have been early in the process, 2012, we did reduce those coefficients by 10%, trying to hit some budgetary scores that were needed at the time. I think if you were to revert back to the original coefficients, that roughly is going to mean another $1 to $1.25 in terms of potential payments. So it moves the margin $1 to $1.25 lower, which if you look back at 2016, that would have made a much larger payment, especially in the May-June 2016 time period, than what we ended up making. So that change all by itself will, in fact, would have made larger payments for dairy producers across the country.
Thank you. Another challenge that, and it's been referenced in the testimony that was provided today, I appreciate it being identified, that we have to look towards the next Farm Bill is how we encourage young people, that succession planning, to get involved in farming and to contribute to the farm economy, especially now when the net farm income is forecasted to be flat or decline. The average age of U.S. farmers is 58 years old. As the population continues to grow, so does our demand for farmers. Dr. Brown testified that in Missouri, producers in the 35 to 44-year-old age group saw debt and asset ratio that nearly doubled from 14.5% to 28.8% from 2012 to 2015. And most young people lack the capital to start a farm, and fewer are eager to incur large sums of debt needed to grow a successful farming operation. Now, I'm working with my friend, Representative Courtney from Connecticut, to reintroduce the Young Farmers Success Act that would provide farmers and ranchers with eligibility for loan forgiveness under the Federal Direct Loan Program. Do you think a program like this is a meaningful way to incentivize young people to get involved in agriculture, and how can we supplement these efforts in the next Farm Bill? And that's for any of the witnesses that would like to take a shot at that.
Well, certainly we had some direction in the last Farm Bill to make the programs a little bit more accessible to younger farmers, and I think that's been by and large successful, but as you mentioned, it's probably not meeting the certain level of farm turnover that we're likely to have. I know that Dr. Outlaw's group has seen that happen with their representative farms, and I would just turn it to him to talk more from a farm-by-farm basis.
From the discussions and the interaction we have with farms, it's been shocking how going and updating that information every other year or so. We have run across a lot more younger farmers than we normally had, and that's a good sign for agriculture. The bad sign is that those folks, according to anybody's numbers, ours, USDA, anyone's numbers, they're more highly leveraged than your older farmers, and they're going to be experiencing the worst of all these financial problems that we're talking about.
Gentleman's time has expired. Ann Custer, 5 minutes.
Thank you, Mr. Chairman, and thank you to our panel. I'm just going to pick up on this dairy question. I'm from the state of New Hampshire, and we're having problems with this margin protection program as well. Sadly, we have witnessed 19 of our 120 dairy farms going out of the commercial dairy business as a result of a drought. We had terrible drought conditions last summer, international market instability, high feed costs, and the federal safety net that just isn't working for our producers. My question is, in 2015, 81% of the dairy farmers enrolled in the margin protection program purchased the insurance coverage above the $4 catastrophic margin level. But in 2016, the figure dropped 68% to the point where only 13% of our dairy farmers had coverage. Part of the problem for us is that the MPP uses the national average feed cost. And my question is, that fails to take into account the higher transportation and labor costs of moving feed to the Northeast when producers can't grow their own. And I'm asking, this is for Dr. Brown, but if anyone else has a comment. You talked about the decreased level of participation. If Congress passes a new farm bill without making the program more responsive or flexible to the regional needs, are you concerned that participation could drop even further? And do you have any suggestions for how we could repair this program going forward?
Yeah, I think if we make no changes and we continue with the current program, we certainly are going to see less and less participation unless we get a serious event similar to 2009, which was very low milk prices, or 2012, which is very high feed costs. Those would have resulted in payments under that $4 catastrophic level. I remind us $4 is about as good a safety net as a concrete floor.
Yeah.
It does not provide much protection. And in terms of the question regarding regional effects, those have been being discussed, I think, over the last several months. I think we're going to have to continue to look at exactly what prices we use to trigger the feed cost side of the equation. And I will sometimes remind us that the risk we want to try to cover from feed cost versus milk price. I think when you look back at 2016, we often see the big decline in milk prices that got folks in trouble. Yet when you look at the feed cost side of the equation, it really offset those lower milk prices, yet that wasn't felt across the United States, especially for many of our producers who grow a large proportion of their own feed. And I think those are some of the issues that we need to continue to look at as we think about which prices should be triggering the feed cost side.
Thank you. And then this is just a question for anyone on the panel. I'm concerned, as I know many Americans are, about the impact of these immigration raids on our agricultural community, and knowing that access to labor is an important component of the economics of any agricultural endeavor. Could you comment, and if we have time, also some of the statements about trade that are coming out of this administration? I'm concerned particularly with immigration, but if you could comment.
Well, on immigration, clearly anything that would reduce the supply of farm labor would raise labor costs to producers at a time of already pretty tight returns. So for many people, that would be indeed a very important consideration to think about. On the trade side, the United States is very dependent on international trade for most agricultural commodities. You know, for our major fuel crops, it can be as high as over 70% in the case of cotton, over 50% in the case of soybeans and sometimes wheat, and even a significant portion of corn. Even though we think about corn primarily being used domestically, we export a lot of it directly and also by means of our meats and so on that we export. So if there were changes made in international trading rules that resulted in lower U.S. agricultural exports, that could have an important effect on the farm economy as well.
Anyone else want to add? We just have a few seconds left.
Well, of course, as you know, the current guest worker program for farm workers has been beset by several problems, but there are fixes that have been contemplated, I think, in several pieces of legislation that have moved in the past and that are being contemplated. Currently, the H-2A program, in 2006, we saw 72,000 workers certified, 72,500 workers certified, and last year it was up over 165,000 workers. So it is certainly providing some access to additional labor, but we know it's an issue.
So my time is up. I just hope that this committee will have the chance to indicate our concerns about the raids and the impact on the farm economy. Thank you.
General Lady's time has expired. Mr. Gibbs?
Thank you, Mr. Chairman. Just quickly, Dr. Kaufman, you know, the current situation in the 1980s, I can vividly remember the 1970s and 1980s. I lived through it. And I think the big difference was we came through in the mid-70s, record farm prices, then we had record interest and hyperinflation, and then we had the disaster price crash. But farmers were highly leveraged in that period as compared to now. Is that a true statement, or would you?
Yeah, certainly leverage was more of a problem and combined with the interest cost that you're describing.
I just wanted to make that clear. Two things I want to hit on. One is, first of all, is obviously we've had a totally different situation we had when we wrote the last farm bill, obviously the commodity prices, and with the ARC program, the PLC program, and crop insurance. You know, we have to, whatever we come up with, Mr. Chairman, as you know, we have to go and sell it to the floor, we have to sell it to the public. And is there a better way to provide protection through crop insurance, obviously for crop losses, but also revenue insurance, and compared to doing it in Title I? Is there something we should be looking at differently? Anybody can respond to that.
Certainly, we've seen the success of the crop insurance program grow over time. We're now over $100 billion in liabilities. Upwards of 90% of the commodity crops are covered, and we see continued increase in participation by specialty crops in the program. So I think the crop insurance program, obviously there was a lot of changes that were introduced in the last farm bill that have had mixed responses. As we noted earlier, the STAX program and the SCO program, for example, haven't been as viewed as successfully as some of the other parts of crop insurance program. Whether crop insurance can be used to provide more of a longer-term structural safety net that's typically provided by the Commodity One programs. I'm sure that there's ways to evaluate that. I would say that at least for right now, the crop insurance program seems to be fairly popular amongst most producers and seems to be working well. Obviously, as we've heard today, there are other ways to think about Commodity One programs, and I'm sure you guys will be debating that over the next year or so.
I guess specifically in the ARC and PLC program, how's that working right now? How would you compare it then?
Well, certainly, as it had been mentioned by some of the other panelists, ARC and PLC program are functioning as designed, although the coverage of those programs vary across the country depending on which producers signed up for the different program. And obviously, those choices that were made in 2014 are held for the life of the Farm Bill. So,
That's right.
And of course, due to the Olympic averaging nature of the ARC program, we know that certainly as revenues have come down, that program has provided substantial payments to a lot of producers, but that's expected to decline over time as those Olympic averaging revenues start to
I need to cut you off.
flatten out.
There's another issue I want to bring up, and that's trade. We all know that trade is very important in agriculture. You know, the reason we have this situation is we're outproducing the demand. One way you can make that up is trade. There's talk, tax reform and the border adjustment tax could be a tariff. Does anybody have a comment on the effects of that, and then the effects with our other countries, our trading partners, and with WTO, if that would be WTO or GATT compliant?
I won't pretend to understand all the WTO implications that there might be, but I know that some issues have been raised about the border adjustment tax that would need to be resolved. Clearly, what happens on taxation of anything that crosses borders will have implications, and you can expect that there will be discussions internationally about them. If we do things that again, restrict our ability to export our products, that's also very important for U.S. agriculture for reasons we talked about.
Yeah, I'm concerned, that because it looks like, to me, it smells like a tariff, 20%, on imports, and could trigger a trade war, and that would be devastating to American agriculture. So I'm really concerned. So I know nobody brought it up in their testimony, but that's something that's, if you just turn on the cable news TV this morning or read the papers, that seems to be the number one issue that's developing and impact. So I think it's raising a lot of red flags, a lot of people. So thank you, Mr. Chairman. You back.
Chairman yields back. Ms. Adams, 5 minutes.
Thank you, Mr. Chairman, and Ranking Member Peterson, and thank you, gentlemen, for being here today. As we begin a new Congress and the reauthorization of the Farm Bill, it's important to remember that the Farm Bills have only been passed into law with bipartisan support, including with the votes of members representing metropolitan areas throughout the United States. Well, the coalition of members of Congress from both farming communities and metropolitan areas are vital for passing a farm bill during this Congress as well. It also requires that we continue to use the Farm Bill as a vehicle for developing new policies to further promote improved access in all communities to local fresh foods, including the many food deserts that are found throughout Charlotte that I represent. Mr. Is it Johannesson? As a follow-up, in addition to increasing local sourcing of foods in Charlotte, there's growing interest in promoting food consumer co-ops as local food markets for communities where the local supermarket has moved out of the neighborhood. Has USDA carried out any research on the economic impact of consumer food co-ops and other community-owned food retailers in underserved communities?
No, I saw that local food co-ops were going to be an interest of yours, and I looked at some of the data that we have collected over the last 5 years or so. And since the 2014 passage of the last Farm Bill, we did put some more programs in place that would support local and regional food distribution, including some work done by the Cooperative Rural Development Mission Area at USDA to support information and toolkits necessary, and some loan programs to support local food co-ops. So in that sense, we have certainly looked at the issue. A successful food co-op, obviously, that's going into an area where you have a lack of other available choices for the population in that region. We'll obviously need a couple things for success. You need to have available funding. You need to have the conditions that are, and certainly demand necessary to keep the food co-op in profitable operation. And so I think there is some information available on that. I'd certainly be glad to compile that and get it back to you for the record.
Thank you, I appreciate it. So what are the economic benefits of extension programs carried out by 1890 institutions in both urban and rural communities throughout the United States?
Well, certainly the Extension Service in the United States, both the 1862 institutions and the 1890 institutions, are sort of a crown jewel of the United States ag system, I would say. It's certainly something that's envied by our other countries around the world. And so I think the benefits to extension can be spoken to much more intimately by the extension folks that are here today. I'll just note, before turning it over to them, that as part of our Ag Outlook Forum, we do have the student diversity competition that we promoted each year. And this year we have 28 graduate students that will be coming in for our forum. And of those, we have, I believe, 10 coming from 1890 institutions and another 11 coming from 1862 institutions and several from Hispanic serving institutions.
Thank you very much, Mr. Chair. I yield back.
Gentlelady yields back. Mr. Crawford, 5 minutes.
Thank you, Mr. Chairman. Appreciate you gentlemen being here today. My colleague, Mr. Gibbs, touched on this a little bit on the border adjustment tax. There's some talk about retaliatory measures that Mexico is not waiting for those, at least not rhetorically, because we've heard some reports coming out that they would no longer buy U.S. corn and they would rely exclusively on Brazil and Argentina. That may just be pure rhetoric. I suspect that it is in the heat of the moment, but in reality, this could happen, correct?
I mean, yes, there's been discussion from Mexican circles about what they might do and to try to get people's attention, if you will. What's very important is to remember that we have a global corn market. And certainly we have lots of advantages of selling our corn into Mexico, and that's hugely important to our industry. It's also true that if you just rearrange trade patterns, the net effect on the corn market may not be all that huge. If we sell products to countries that Brazil formerly sold things to, and Brazil picked up the Brazilian market, the effect on the corn market is not as large as if Mexico just disappeared from the corn market entirely. So it's very important to watch this discussion as it goes forward.
Well, it's particularly important, to me personally. I represent a big rice district. It's 25% of the U.S. rice market. Mexico is our #1 customer. Right. So while they made that statement about corn, I think it's safe to say they would extend that to the U.S. rice industry as well. You agree?
I mean, certainly. Mexico is our #3 trading partner on the export side, and so what happens there is hugely important to our sector.
Let me switch gears just a little bit. I want to talk about loss of farms that's taken place. I think everybody in this room that has a rural district would probably agree that we've seen precipitous loss of farmers. But we haven't really talked about the infrastructure associated with that production base. I'm concerned about what kind of impact this might have on our ag infrastructure, our equipment dealers, our bankers, processing, and other components of the ag sector. Can either comment on that or what you foresee?
I'll just start by saying that, certainly we've seen a lot happen already. I mean, obviously, farm equipment sales are far off the peak levels, right, and that's had ramifications across, lots of mid-America. So those things are very real, and if the pressures continue, you expect more of that to happen in front of us.
Dr. Outlaw, let me ask you, the cotton industry, not a real pretty picture over the last few years. A lot of factors. A lot of it had to do with China stockpiling cotton, as we know. Some of it's weather-related. We had a steep decline in cotton acres in my district, some 40% decline year over year in last crop year. The 14 Farm Bill, cotton was taken out of Title I. We touched on that a little bit. It opted for the STAX program, which has performed much worse than expected. How are farmers going to cope with that situation, and what kind of policy recommendations would you make in light of the way the STAX program has performed?
Well, one of the ways that the farmers have coped is that they have used the generic base to plant other crops that might have more potential for them. So that's been a very big positive, having that generic base available. But really, all these crops need some sort of price protection, and not having it makes the producers and their lenders, who have a partnership, look at other commodities as options a little bit stronger than cotton. And cotton's infrastructure is so unique, which is how you started this question. When the cotton infrastructure moves out of a community, it's very difficult to get it back. Mm-hmm. And so basically, I think that there has to be some sort of price protection afforded to cotton producers, whether it's through the seed, that will work, obviously, but there has to be some sort of protection in this next bill.
In the 45 seconds I have left, if anyone wants to comment on the viability of ag trade in Cuba, I've got a bill that would lift the credit restriction. That's really the only impediment to us selling U.S. ag commodities in Cuba. Would anybody like to weigh in on that, what the potential there is for U.S. agriculture?
I think initial analysis that we've done at the department suggests that we could triple trade to Cuba under certain conditions, and certainly, as has been noted, improving market access and expanding trade is key for U.S. agriculture as we continue to see increasing productivity like we did last year. We need to find places to sell that overseas.
Thank you. My time's expired.
Jim's time expired. Mr. Lawson, Florida.
Thank you very much, Mr. Chairman, and thanks for this committee to be here this morning. I represent 6 counties in North Florida, rural counties in North Florida, so I know the importance of the farm economics and recovery. We have watched cattle prices begin to weaken over the last year or so, and can you tell, that's one question, can you tell us what is behind your outlook for increasing productivity, even as prices continue to decline? And the second question, we are seeing cotton prices recover sometime this year, and understand that the outlook is for that to continue. What factors are influencing the recovery, and are they likely to remain at this pace for a long time?
I'll touch briefly on those and then turn it over to the other folks on the panel to chime in. Certainly we're seeing cattle prices pressured downwards. We're expected to see record production next year, nevertheless. A part of that is lower feed costs. As has been mentioned, the January cattle inventory estimated total cattle and calf numbers in 17 had increased for the 3rd consecutive year. It's still recovery from the drought that we saw in the Southern Plains earlier in 2011, 12, and 13. Beef cow numbers are above 2016, and producers indicate they're holding more heifers in addition for the breeding herd. The year-over-year increase in the number of cattle outside feedlots is also indicative of increasing production. So we are likely to see record production in 2017. Meanwhile, as prices come down, the cattle cycle is a longer run phenomenon that perhaps Dr. Brown can mention in a second. On the cotton side, we are seeing China, as had been mentioned, had built up significant stocks, as much as 60%. 2 years ago of the world's global stocks were held in China. They've been unwinding that stock position, as well as moderating their domestic support policies for their cotton producers in China. So we are seeing an increase in the amount of auctioning of their stocks that they were holding. They're down about 10 million bales, 10 million tons since last year. They're holding about 48% of the global stock right now. Despite that fact, the U.S. continues to sell our cotton at a premium, higher quality cotton, and we expect that to continue going forward. And certainly, we have seen a recovery to a certain degree in global economic demand for cotton, an increase in price for crude oil, which decreases the attractiveness of synthetics as a substitute.
So I think 2 back-to-back years of 1 million head growth in beef cow numbers in the United States is much of what's at play in terms of lower cattle prices. When I look back, I will say 2014, when we had $3 calves, made the industry want to expand. And that expansion is just now what we're dealing with as we look ahead. You know, it takes the industry a long time to make changes in the supply side because of just the biological nature of the industry. But I'm afraid we're not done with that expansion. Much of the expansion is, again, occurring in the Midwest, Texas, Oklahoma, Missouri, where we had a lot of drought conditions occur in 2012 and 2013, and we're just rebuilding herds back to where they were pre-drought conditions. But the supply side of the industry that gives us 3% more meat supplies in 2016, another 3% in 2017, spells for me that we're probably not done in terms of where lower cattle prices head.
Jim Munoz back. Thank you, Ms. Lawson. Ms. Hartzler, 5 minutes.
Thank you. Sounds like we all need to eat more beef. But want to, and wear more cotton, I guess. But anyway, wanted to ask you, Dr. Brown, about the dairy policy. You talked about in your testimony the low participation and how it's like concrete floor, the current safety net. And so I want to run a couple of ideas by you and then just ask you generally what you think what we need to do in 2014. But based on your testimony, we say finding ways to spread risk across federal policy may be to balance the balance needed to provide a better safety net. So under the current Farm Bill, dairy producers must make a choice between the MPP dairy and the livestock gross margin dairy program, which is run by the Risk Management Agency. So as you know, once farmers make that choice, they're locked into it for the life of the Farm Bill. However, these programs offer very different forms of risk protection. So in your view, what would be the policy consequences of either allowing dairy farmers to participate in both programs at once, or at the very least, allowing farmers to decide each year which program they'd like to be in?
Yeah, so I think that choice is very interesting because you could envision a program where MPP provides kind of the catastrophic coverage, if you will, and yet you provide producers the chance to maybe buy up via the LGM insurance route. So there may be some options as we look ahead into the next Farm Bill. I think we always have to be careful that those complement each other and don't compete, i.e. that producers somehow can't double dip in terms of those two programs, and that we figure out how to make them work together. But it might provide the ability to use both in a way that's helpful. And I will say LGM for dairy might provide a little more short-term decision process for producers, as they can make that on a month-by-month basis, whereas currently when you think about MPP, that's an annual decision that we've made. So it might allow producers a little more flexibility if we give them the choice. We probably have to talk about uncapping LGM for dairy, or at least talking about the cap for LGM for dairy relative to where it sits today as well.
Okay, well, that kind of goes into the next question, which talks about making programs workable and responsive. So currently, MPP Dairy calculates margins on a bi-monthly basis. So this can make the program less timely for participating farmers, as margins can fluctuate on a monthly basis. Do you think a monthly calculation would make the program more effective and more attractive for producers?
Certainly going to a monthly calculation means that we'll get payments more often. If you look back at 2016, if we would have done it month by month, we would have gotten larger payments than we ended up with using the bi-monthly process that was laid out in the 2014 Farm Bill. So I do think that's more what the dairy industry is accustomed to, is seeing month to month. They get a milk check every month, so it might make more sense to give them payments on a monthly basis as well.
Mm-hmm. And from both your testimony and Dr. Westhoff's, you talked about how the anticipated amount of money that was going to go out in these programs fell far short of actually what was going out. So it seems to be that there's some extra money there that had been budgeted that could be used perhaps to provide that relief, So the last question, just in general, what do you think needs to be done to fix the dairy program to make it truly responsive?
Well, I think number one, we have to learn from our experience. We made a big swing in 2014 in terms of the dairy policy change that we made. We are learning that producers are not as interested in participation as maybe we thought when the 2014 Farm Bill was passed, understanding that our working assumption was that 70% of milk production would be signed up at $6.50 to find out now that it's less than 2% is signed up at that $6.50 level should tell us participation is less, that perhaps government costs are less than we expected, and I think that might provide us then what are the alternatives that provide a better safety net and get a more reasonable cost estimate for those different alternatives.
Great. Thank you very much. I yield back. Appreciate it.
Gentlelady yields back. Mr. Panetta, 5 minutes.
Thank you, Mr. Chairman, and thanks to all of you gentlemen for being here. Appreciate your testimony as well as your preparation for being here to testify. Thank you. Mr. Johansson, if I could, you talked about, well, I come from the Central Coast of California. I think my committee members are going to get sick of me saying I come from the salad bowl of the world, where there's over 100 specialty crops grown there. Those types of crops, we can't just run a machine through the fields, unfortunately. We need a labor force to go in there and pick them. Obviously, with the immigration issues that we've been having, and you talk to farmers for the past year and then some, they basically say, even with the drought, water is not the number one issue, labor is the number one issue. You said that there are some fixes. You mentioned the rise in number of, from 72,000 to 165,000. What else can be done when it comes to the H-2A program? What can we be focused on? Because I believe that's going to be, that's where we can go to help alleviate the situation.
Certainly I would defer any policy responses to when we get confirmation of a new secretary, and I was just noting that I think over the past several years, Congress, both in the House and the Senate side, have contemplated adjustments to the H-2A program to make it more workable for farmers, to use that program to get a more stable supply of labor. And I think in those various bills, there's a good number of ideas that could work with both labor or with USDA, depending on how those different facilitating adjustments were made. So be glad to put a more formal response together for you for the record, and certainly would like to defer to the new secretary when he has a chance to get on board.
Understood. I look forward to that response. Thank you very much. I yield back my time.
Jimmy yields back. Ronnie Davis, 5 minutes.
Thank you, Mr. Chairman, and I'm glad I got to follow my colleague, Mr. Panetta, because I've actually seen his district, and it is the salad bowl of America. I got to witness organic leafy greens being put into the bags that end up making it to the grocery stores in my district. And thankfully, my wife was with me because she got to see the same greens going in the generic bag and the name brand bag. So I always remind her of that when we're at the store. Let's go ahead and just buy that one. So thank you for what your district does. And I want to segue that into what my district does in central Illinois. I don't have a lot of specialty crops, but I have what I call our special crops, corn and soybeans. And today's hearing's about the farm economy. And the current state of affairs in my area, it's pretty troubling in my state. What is also troubling to me is that many of my colleagues on both sides of the aisle, they rally, we talk about rallying around rural America, and instead of seeing that, I see that some trot out the same proposals to gut the renewable fuel standard. And it's a program that I believe drives growth in not only rural America, but throughout the country. And for anyone who still thinks that the RFS is causing commodity prices to skyrocket, let me point out the following. We're producing more ethanol than ever before. The price of corn is lower today than it was when the RFS was expanded. Last year, food prices fell in the longest decline since the 2009 recession, and the overall 2016 food price fell below 2015, the first annual decline since 1967. Claims of corn being diverted from food products ring hollow when we see that even during the drought of 2012, America's farmers produced the 8th largest corn crop in history with record harvests in 14, 15, and 16. I want to ask two questions, Dr. Johansson. What can Congress do to encourage growth in the biofuel sector, and would repealing the RFS contribute to instability in the agricultural sector, particularly in the corn markets?
Well, it's a great question.
Thank you. Two.
First, I'll note that in the weekly briefing packets we put together for senior leadership, we do have 2 slides in there from Central Illinois cash markets, one for corn and one for soybeans.
Thank you.
So those feature prominently in our briefing package each week. Turning to the renewable fuel standard, as you noted, we are currently producing, conventionally, we always thought capacity for ethanol production was around 15 billion gallons. Annualized basis right now, we're at 16 billion gallons. So we are producing more ethanol, and that's primarily a function of the fact that we're getting better at it over time. And we're exporting more than we have in the past. So I think in terms of providing incentives for increased production, I think by and large, from the RFS standpoint, the conventional standard's capped at 15 billion gallons, so additional gallons that are produced above that are going to have to find a home, for the most part, in the export market or in higher blends. So those are 2 opportunities for increasing conventional corn ethanol production past the 15 billion gallon cap. The question about whether or not changing the RFS in such a way to get rid of the mandates, essentially, what would that effect have on corn production and prices, et cetera, and the rural economy, I think is your question. I think that's a 2-part answer to that, and I'll give you an economist's answer, right? So on the one hand, in the near term, I think most studies have shown that you wouldn't see a lot of changes, because the way that the refinery sector has set itself up, they produce a blend stock that assumes that you're going to have a 10% mix with ethanol. So changing the refinery technical engineering standards will take some time if they were to do that. I'll also point out that you still need octane in your gasoline, and ethanol provides the cheapest octane, so you're still going to have a good amount of ethanol production. If you didn't mandate it, I think it would vary more by price. So right now, you have gasoline prices are relatively low, although they have been ticking up lately. As a substitute, ethanol has generally been cheaper than gasoline, but right now it's about, I guess it's about break even. I don't know, defer to people on the panel. So I think if you were to change the mandate in such a way that it would become more, I guess, reflective of the relative price you have between corn ethanol and gasoline, similar as to what you see in Brazil with respect to their sugarcane and gasoline usage.
Thank you. Gentleman's time expired. Mr. Soto?
Thank you, Mr. Chairman, and I'm very hopeful by hearing concerns about a potential trade war or immigration crackdown, since either of those things would be a disaster for our farmers, for rural America, particularly when we see that agriculture's just getting by now. I'm from Florida's Fighting Ninth, which we have the top cattle-producing county in the state, Osceola County, and Congressman Lawson already touched on that. And I also have the second highest citrus-producing county in the state, Polk County, and we are taking a beating on citrus right now due to the greening disease. So I was wondering what you all could advise us as far as what we should be putting into the Farm Bill. Citrus is a huge crop in both Florida, Texas, California, and many other states. So would love to hear your thoughts on that.
As you mentioned, the Florida citrus crop has been getting hammered by citrus greening over the last 5 years or so, probably even a little bit longer. And we've noted that decrease in production in our reports at USDA. I think we're down to one of the lowest Florida orange crops that we've seen in probably since back to the 60s, if I'm not mistaken, even perhaps further back.
We're down 70% from over a decade ago.
Yeah. So in terms of assistance that can be provided, we're certainly working as the chairman of the Federal Crop Insurance Corporation, we're certainly always looking to find new products that provide help to tree crop growers, and we've added a number of tree crops, including citrus crops, to the crop insurance portfolio. I think that will continue on into the future. Research and development on ways to address diseases like citrus greening are another way that USDA has been active in trying to find a solution for producers down in Florida. Regarding new Farm Bill proposals, I'll turn that to folks that can speak more freely about that.
Just to add a quick point, as a university researcher, it might be a little self-serving to say that we need more university research, but scenario we're obviously trying to get on top of the issues is obviously very critical to the industry.
Well, thank you. And we were blessed to have over 125 million assisted through the last Farm Bill. And the situation is dire in our state and in our nation. And we'll be drinking mostly Brazilian orange juice if we don't get active on this. And so I just wanted to make sure we highlighted it. The other issue I wanted to hear you all speak about is found it a little disturbing that young farmers seem to be in far more debt than older farmers, and it seems to trace a similar line with student loans and the like of young professionals as opposed to 10, 20 years ago. So what can we do to help our young farmers get out of debt like the generation of farmers before them?
I'd add a few things and then defer to probably Rob. But the programs that have been put in the previous Farm Bill seem to work very well. I have received quite a bit of feedback from the producers that we work with, the young producers, saying they really appreciate the consideration that was provided in the past Farm Bill with lower interest rates and things like that. That has been helpful to a good extent. The big question is, and it's not easy to handle, is agriculture is a very capital-intensive occupation, and if you want to have control of land where you control the outcome of getting to farm it every year, you have to buy it, and that's the problem. And so I know there are a lot of programs geared towards new farmers, but anything you can do to try to help alleviate some of that cost would probably be appreciated.
Thank you. I yield back.
Jim yields back. Mr. Allen, 5 minutes.
Thank you, Mr. Chairman. And as you know, in my home state of Georgia, agriculture is the #1 industry. And according to the Georgia Cotton Commission in 2014, Georgia planted around 1.38 million acres of cotton and had an average yield of about 900 pounds per acre. Specifically in my district, cotton is among the largest crops planted, and currently many of my farmers are very concerned with, obviously, and the gen folks, and the folks that make the equipment. Everybody's got great concern about what is the future of our economics and as far as cotton. And in speaking to the Farm Bill, when I've talked to our farmers, they are particularly concerned with two things. One, crop insurance is a big deal, and then some type of price support. And I know the last Farm Bill, commodity prices were, I think, at all-time highs, and today, obviously, they're very low. And I've talked to commodity people to try to understand that market and, maybe how we can smooth out that line, because that seems to be the biggest problem is in planning and then, and our farmers say, let us worry about the yields. We'll deal with that. But we kind of got to know what and where these things are going to be. What is really driving this commodity, like the higher prices before and now the low prices? And is there a fix? Is there something we can do? And is it caused by trade? I don't know. Dr. Johansson, you want to start with that and tell us how we can stabilize that thing?
Well, I think not so much for cotton prices, I guess, but I would say that volatility in commodity prices in general would be expected going forward to be less volatile than we've seen, both on the upside and the downside. Our projection is for relatively flat prices going forward, and over the next 10 years, we don't expect to see dramatic increases or decreases. I think Dr. Westhoff mentioned that, of course, things can change that will change that situation, whether it's a drought or a change in policy or a change in trading arrangements could affect that either for a positive or a negative. Just due to the fact that we do have so many relatively high global stocks right now, I would say that that's going to minimize any upward or downward movement in the near term. I think going out 10 years, we do still forecast the U.S. to be the #1 cotton exporter going forward. And by that time, China's going to be the #1 cotton importer. So to the extent that we maintain a good trading relationship with our #1 customer, I think that will keep the picture in terms of at least our outlook for trade going forward stable.
What drove up the commodity prices that we saw a few years ago?
Was any number of factors, obviously. We did have 3 straight years from 2010 to 2012 when global average yields for the grains and oilseeds are below trend. And so that made not as much commodity available in the world. China was increasing its consumption very dramatically. And we also had, the biofuel revolution had just, passed its most extreme phase in this country. So we had a very severe shortage of stocks and many commodities across the board, drove prices dramatically higher. Since 2012, we now have 4 straight years of above average yields. It's pushed prices lower. And that suggests as we go forward, if we have more normal yields going forward, that might give you a bit of a price recovery. But we're starting from very high levels of stocks, as Dr. Johansson indicated, so it'll take some time to work through those.
Okay. As far as obviously cotton was pretty much ignored in the last Farm Bill. What going forward and what can we do as far as cotton is concerned in the new Farm Bill?
I've already said it once, but I'll just, cotton needs to have some sort of price protection on either lint or seed, and it looks like seed is an avenue that might work. So that has to happen.
Okay. All right. Well, I'll yield back, Mr. Chairman.
Chairman yields back. Dr. Kaufman has a 12 o'clock hard stop, so as we were running past, Dr. Kaufman, just when you need to leave, sir, thank you very much for being here this morning. Ms. Lisa Blunt, Rochester, 5 minutes.
Thank you, Mr. Chairman and Ranking Member Peterson. I also want to thank the panel. I feel like you've simultaneously given us a glass half empty and full. So thank you for that. And my question is actually for Dr. Kaufman. I represent the state of Delaware, and so many of you might know we have farmers, as many chickens as people. We also have financial services sector that's very important. And so first I wanted to clarify, did I understand you to say in your testimony that there's been a reduction in loan volume for operating expenses? That's the first part of the question. And then is this solely due to lower input prices because farmers don't need loans to pay for fuel or fertilizer or seeds, et cetera? Or is it a result of lenders being skittish about extending credit to farmers, or both?
Excuse me, it does seem like it's a combination of several things. To clarify first to the first question, outstanding farm debt has still been rising, so looking at last year, it had been increasing, but perhaps at a slower pace. Some of the data that we collect that reflects new loan originations shows that there was a notable slowdown in the fourth quarter of last year in terms of loan volumes at commercial banks, and I think that's due to a couple factors. First, as you noted on the input cost side, certainly lower fertilizer prices, lower livestock prices in terms of inputs, that has represented some reduction. I think anecdotally we've also heard some statements that prepaid expenses were a bit lower in the fourth quarter, so farmers perhaps delaying some of those decisions. We did in many areas see stronger than expected crop yields, and so in terms of the timing on cash flow and when some of those loans might be made, I think that was also a contributing factor. And then certainly lastly, to your point, I think that there has been a bit of hesitation and apprehension going through this loan renewal season, just making sure that finances are in order before getting to the next phase of production.
Does anybody else on the panel have a comment? Okay, thank you. I yield back my time.
Gentlelady is back. Dr. Marshall, 5 minutes.
Good morning, panel. Let me add my gratitude for being here and bring greetings from the state of Kansas. As I think about Kansas, I would bring to you just not the macroscopic level. When you talk about income and of $150 billion of income, it doesn't mean much to me, but the average income for the farmer in Kansas for 2015 was $6,000. For 2016, it'll be less. In 2017, it'll be even less. And it's very hard to raise 2 kids on $6,000 a year. As a physician, I hate to use the term crisis ever, but it's certainly nearing that. The economy in my district is 60% agriculture. So when you have an ag economic issue, you have a statewide economic issue, and the dominoes are starting to fall. So we are very, very concerned in Kansas. My first question is for Dr. Kaufman, who probably has the closest connection to Kansas. How severe have low commodity prices been on farmers' bottom lines? And are we seeing farmers going out of business yet, or are they still managing to live off equity?
So to the first question on low commodity prices, it certainly is having an impact. We aren't seeing a great deal of an increase in bankruptcies and farm bankruptcies, and even loan delinquency rates have been relatively low. That said, most of us often report things in averages, and we talk about the farm sector overall, but certainly there are pockets, there are areas where things have perhaps been worse than some others. As we look at the downturn in commodity prices and as we hear concerns being voiced by agricultural lenders, certainly when we know that the environment in wheat has been particularly pessimistic, with prices much lower in wheat than they had been in other commodities. And as we look at the cattle sector, though prices have improved over the past couple of months, the previous 18 months had not been so good. And so in terms of lenders expressing some concern about cash flow in those areas, and obviously both of those sectors are important for the Central Plains, so that's been an area where I think that there has been more concern.
Okay, thank you. Well, my next question is for Dr. Brown. Most people don't realize this, but I represent the fastest growing dairy sector in the country. So dairy is becoming a bigger issue as well. And you've answered bits of this question and maybe all of it, but I want to, this is real important to my dairy people. So in your opinion, what combination of improved payments and reduced costs to participate would induce significant numbers of dairy farmers to sign up at more effective, higher margin coverage levels of the MPP program? And again, you've answered bits and pieces of that, but I certainly want you to know we're concerned about it too.
Yeah, absolutely. So I'll start, number one, with talking about premiums for a minute.
Okay.
It seems to me that one of the options that we've talked about is lowering premiums for different levels of MPP participation as a way to get increased use of the program. However, I found dairy producers very disinterested in making payments for premiums and getting nothing in return. And so I'm not certain that lowering premiums, all else equal, generates a lot of additional participation in the program. However, premiums have been higher than have been needed to pay for the program thus far. So I think that's one area we have to think hard about how that affects participation if we were to lower premiums. The other side of it is, what is an appropriate safety net? You know, we talk about currently with $4 to $8 coverage options, and 4 being the catastrophic. How do we help pull that catastrophic level up? It is just very important that we think carefully about the policy as we move forward, as if we end up with policy that's too lucrative, We've all experienced that from the 1980s dairy programs that we had, and that was not much fun either. So it is a very tight, it's a tightrope we have to walk between providing a safety net without it becoming too lucrative.
Okay. Quick question to Dr. Johansson. We're all awash in the supply of many of our major commodities. What can we do to increase demand for these products?
Certainly, we know that, as I mentioned earlier, coming off of the kind of record harvest we've had, where we had all three major commodities, corn, soybeans, and wheat, have record yields, first time in 40 years that's happened. Agricultural productivity continues to move forward, and it's essential that we find new markets for those products. Certainly, we are putting R&D into trying to develop new products from corn, for example. But I think the key will be trade. We need to find ability to continue to move our products overseas to new markets.
Gentleman's time has expired. Ms. Plaskett, 5 minutes.
Yes, thank you, Mr. Chairman, and thank you, witnesses, for being here. I have a question for you, and I don't know who would be the appropriate person to respond to this. However, we've seen in recent months the discussion of rural America, and its emergence is really a real focus of many of us here in Washington and in terms of politics. As we move from a post-industrial society in many respects, there seems to be, and tell me if I'm correct or incorrect, a tension in the rural areas between agriculture and that post-industrial sector. I know in the Virgin Islands, where I'm from, we are now seeing the closing of so many of our industries, and people are going back to agriculture as a source, as an economic driver. What do you see as the emergence of agriculture? Will it remain the strongest economic driver in rural areas? Is it changing as we see the changing in pricing happening? What is the outlook for that? I see they're looking over in that corner, either Dr. Johansson or Dr. Kaufman.
I think it's a great question, really interesting, and I think you'll get 5 different answers when you ask 5 different economists.
That sounds like you sound like us up here,
But,
all saying the same thing.
I think we've seen consolidation occur in agriculture in the United States, as well as in the sectors that are upstream and downstream of agriculture. I think when you enter into a tight economic situation like we're seeing right now, that you are likely to see additional consolidation occur. Obviously, that consolidation is slowed down substantially from what we had earlier, over the last 50 years or so. But I would suspect that we do see additional consolidation as producers that have more liquidity and have better financial bottom lines are able to increase the size of their production, despite the fact that prices are relatively low, but I think we project them to be stable. So I think in that situation, you could see additional consolidation in several sectors.
Well, when you talk about the consolidation of the market, of the products and what's happening in the industry, what is the support that we in the Farm Bill could give to expanding other markets? We're looking at the global market, but as my colleague Ms. Adams was talking about, there's also the urban markets that could be an additional market that we have not really supported and allowed growth in. If there are food deserts in America, then that's obviously a marketplace that we should be moving into. How do we as members of Congress support that?
Well, I think the business sector is very good at finding ways to meet demand, and when we have demand occurring, certainly in the for diverse products like organics or other types of products in that sector, we are seeing producers in the United States as well as processors respond to that demand. I think that's likely to continue. As trying to pick winners and losers is, from my perspective, never a very easy thing to do when we look towards creating particular provisions. In general, I like to say that if you let the business opportunities operate with transparent to market signals, then you're going to see the most efficient allocation of resources. But that's again, that's sort of a,
So that's interesting you talk about demand, because I believe that there's a demand in these food deserts. It's just not, we haven't found a way to bring the pricing or the support to it for them to be able to meet the demand of their palates, to be able to have those foods. But another question I had is, in the period of low pricing that we have now, there seems to be, and will there be a delay in purchasing of equipment or machinery among farmers? How does that affect, are there ways for us to encourage purchasing of products? I know in the Virgin Islands we have cooperatives that are looking at food processing plants to support production. What are the ways that the Farm Bill can support that?
Well, again, just make the point that obviously when agriculture suffers, it has effect on lots of upstream and downstream industries. And so we've seen that play out the last couple of years here. That's going to be an issue going forward. So trying to make agriculture healthier will, of course, have ramifications for the rest of the economy as well.
Yeah,
So
because
again, just general things you do to order to support agriculture.
I'm just concerned because I know that, having the equipment will assist them, but if the prices are low, that's going to mean a delay in them being able to purchase those things.
Right.
Thank you. Thank you, Mr. Chairman.
Gentlelady's time back. The lady's time has expired. Mr. Dunn, gentlelady. Oh, Mr. Dunn, 5 minutes.
Thank you, Mr. Chairman. I'd like to address my question to Dr. Johansson. The greatest concerns that I hear from timber owners in my district and harvesters regard policy variables related to regulatory and tax uncertainties, which impact their management practices and business models. Certainly wildfires, insects, and disease all are concerns, and I'll recognize them only to bring them up at a later time. But what I'd like to have from you, if I could, is any additional indicators that you're tracking, and can you discuss your outlook for the timber industry?
so you're correct that the Forest Service is part of USDA, although the Forest Service economists and folks that work at the Forest Service generally provide that outlook. I don't focus a great deal of attention on that outlook when I develop the outlook, which I will be doing next week for the agricultural sector. That being said, we know that, as you mentioned, timber production and timber resources in the United States has been responding to a lot of signals. You have the private sector forests and you have the public sector forests. They're managed slightly differently. Interest rates are certainly going to play a big role in how those are managed in terms of timber managers looking at what their optimal harvest schedule is. There's a lot of, obviously, interaction with our trading partners on some timber issues. There's certainly in California, we've seen, due to the drought there's a lot of timber issues in terms of trying to remove a lot of that dead timber that we are seeing as a result of the drought. Of course, in the Southeast, you have completely different issues where we're trying to make sure that we continue finding opportunities to, export a lot of those wood pellet products overseas to a lot of demand that's coming from Europe. And so I would imagine that it's a tough question to answer. A lot of issues there tied up in timber, and I would certainly be happy to
Let me turn your
connect you.
attention to a different one then. Let's start, pay attention to dairy just for a moment there. Producers are faced with very poor returns currently in the price of milk. They're very low, and they remain concerned in my district regarding the outlook for the dairy sector. However, the USDA's report called for increasing milk production and increasing milk prices. Can you address that in 17?
Yeah, and I'll just touch on that briefly, and then I'm going to let Dr. Brown
Yeah, and I was
speak,
going to
because
ask
he's
Dr. Brown the same question.
You're right. Our 2017 dairy outlook right now is for all milk price to be upwards of about $17, $18 a hundredweight. That's up from the previous year. And in addition, we are seeing increasing productivity in milk per cow, increase in the dairy herd, due to some stronger signals from abroad in terms of being able to export that. I'll stop.
Export's key to that?
Excuse
Do
me?
you think exporting is key to that?
I think exporting is key to that, yes.
All right.
Dr. Brown.
Yes, I would agree. Higher milk prices in 2017 are not coming from less supply. We're going to have more milk supplies again in 2017. I think it's a combination of demand for U.S. dairy products abroad, as well as you look at a number of other countries, Oceania in particular, where milk supplies are down relative to a year ago, that I think are important to the higher price outlook. I remind us the risk around these outlooks, and I will say when you are very much dependent on increases in exports, we could look back a few months here down the road and not get the kind of milk price increase that we think if we don't get a strong increase in U.S. dairy exports in 2017.
Well, let's hope we do. Thank you very much, Mr. Chairman. I yield back.
Chairman yields back. Mr. Arrington, 5 minutes.
Thank you, Mr. Chairman, and thank you, panelists. I think you'll agree with me, but I certainly believe strongly that if we're going to make America great again, we need a strong and sustainable rural America. I don't know who's going to feed and clothe the American people if rural America isn't healthy, and I don't know who is going to fuel the American economy if rural America isn't healthy. I know there are a lot of factors. I'm on budget. We've been talking about regulatory burden, the $58 billion in additional reg burden to our community hospitals out of ACA. I have more rural community hospitals in my district than any other in the state of Texas, and they're just getting crushed, and they're going out of business, and there are 600 on the brink of going out of business around the country, and I think that having healthcare, viable healthcare, is about sustaining rural communities. No greater effect than our agriculture, though, especially where I come from, 29 rural counties in West Texas. And I just came from a budget hearing, and I got to say, it's kind of thrown me off. I had a really good statement or two about rural America and free trade and fair trade and a good, strong farm bill. I don't think it's drought. I don't think it's insects. I don't think it's trade wars. I think the meeting I just came from, where we have a fiscal crisis and where we have mandatory spending eating away at very important discretionary investment, domestic investment, is going to be the biggest challenge of the 21st century. And every committee, every policy committee, every authorization committee. I represent the largest cotton patch in the world. And I want to ask you, if I may, some questions about cotton, and I'm just going to tee them up, and if you guys would knock them down in any order that you so choose. What was the rationale behind the Brazilian case and that they made to WTO in pulling cotton out of the Farm Bill, out of the Title I as a covered commodity? What was the rationale? Just real quickly.
The argument was that the U.S. Support for cotton via its both its direct payment programs as well as some of the other programs was causing adverse harm to Brazilian producers due to the fact that prices were low.
Could that argument or that rationale be applied to other crops?
Yes.
What would happen if all of our crops were outside of the safety net? Could one word
essentially if we were to not have any farm bill?
Yeah, let's apply that rationale to every crop, pull it out of the safety net. Is the one word disaster come to mind, or is it just would be a challenge, an adjustment? Anybody? Federal Reserve, Dr. Kaufman?
Certainly, if it were to happen immediately, it would be a shock, as there are a number of lenders that would look to crop insurance as one of the risk management strategies, and borrowers, as Dr. Johansson reflected, are primarily interested in the products.
I'll tell you, with cotton in West Texas, it's been a disaster. I can't imagine if it were the citrus guys or the soybean and corn that it's been a disaster. Let me move on to the next question. How much does China's dumping and their mass subsidization, I understand that they're allowed to subsidize because they're a developing nation, which I find hard to believe that we've agreed to do any kind of trade deals when those are provisions, but how does their
dumping and mass subsidization of cotton affect the global market and specifically the U.S. cotton producer? Significant, slight, de minimis?
As I mentioned earlier, China did have and still does have significant cotton stocks relative to the global level of stockholding abroad. They're currently about 50% of total global stocks, and they were about 60% as recently as last year. The way that we've addressed that in terms of our outlook is that it does put a damper on potential for upward price movements due to the fact that you have that many stocks out there.
National security, I think it's number one, and I think this is a big part of it. I got one last question, if the chairman will
Sorry,
allow
the
me.
gentleman, no, gentleman's time has expired.
Okay.
Mr. Fazio, 5 minutes.
Thank you, Mr. Chairman. I appreciate the panel coming today, and I very much appreciate your advice and expertise in terms of dealing with the 2018 Farm Bill. I represent a district in the Catskills and Mid-Hudson Valley in upstate New York, and I can tell you I've talked to dozens of dairy farmers, and not a single one of them thinks the margin protection program works. They're very cynical about it, and some are angry and some are just resigned. We've listened to a number of the discussions, depending on what commodity we're dealing with or whether it's dairy, about the need for exports and the need for trade. I'm a little concerned about the border adjustment issue, especially when I hear that the value of the dollar will rise, and it's somewhat speculative in terms of that rise, but what are the consequences? What are the unintended consequences of it? So I guess this is to Dr. Johansson as well as the other panelists, but particularly Dr. Brown. What can we be doing? Because it seems to me we just go through this boom-bust cycle. What can we be doing to expand the domestic market for fluid milk and other dairy products? We're spending more now for this stuff, bottled water, than we are for milk. And I look at the USDA that says we can't sell a whole or a 2% milk or a flavored milk in a school lunch program. And yet the other parts of the government are saying, how do we come up with programs to shield people from the results of lower prices? And yet we don't seem to be spending enough time and effort to actually increase our consumption of what many of us would argue is a much more desirable product than some of the other things that we may be consuming as Americans and as school children. So perhaps we could address the question of what should we be looking at, what could we be doing to increase our domestic consumption of fluid milk and dairy products?
Consumer trends have, of course, always been very difficult to follow. We've gone through the boom and bust of consumers wanting more dairy fat, less dairy fat in the diets. I think when you look at the very recent data, however, we're starting to see some signs of some more positives occurring with some of the more whole milk products starting to show a little bit of growth in terms of demand that we haven't seen for a long time. There's a lot of work left to do in terms of product innovation. I see the industry spending a lot of time trying to figure out and answer that question with some of the new products that are on the marketplace today. But we have to continue to think about the packaging and delivery of fluid milk products to consumers, trying to find new experiences for them to consume milk products. That's I think, some of the few things that are available to us right away that might help stem what's been a long-term decline in fluid milk consumption.
No, I agree. I think we are seeing a projection for increased domestic milk consumption through the products that Dr. Brown had talked about, and I would expect some of those trends to continue. In addition, marketers are finding ways to get milk into the grocery store and find margin there for producers, such as through organic programs and organic production. But again, with the forecast that at least that we have, and I think it's a little bit more optimistic than the FAPRI forecast in terms of production going forward over the baseline period, trade will be essential for making sure that we are able to move those products overseas and maintain margin for our dairy producers.
Right, and I realize that Dr. Johansson might not be able to comment on this, but one thing that you just mentioned, when you mentioned organic, I have an organic yogurt producer in my district. They're paying $38 a hundredweight for milk, and it's certainly, I think we'll see more and more producers looking in that direction. But Dr. Brown and perhaps the others, what about this whole business of school lunches and 2% and whole milk? I mean, does this make any sense whatsoever?
I think we're going to have to continue to evaluate what we see in the school lunch side to make certain that we put in front of students what's nutritionally sound. I think we do go through ebb and flow in terms of what we think is quote, if you will, good. And I think we have gone through a period of time where maybe we were avoiding some of the higher fat products that are out there to now maybe realize that in correct quantities, we can talk about a different makeup of school lunch than we've had in the past. So perhaps that's more debate that we need to have as we move forward.
Gentleman's time has expired. Mr. Lucas, 5 minutes.
Thank you, Mr. Chairman, and I appreciate the opportunity to be here today, and I would be remiss if I didn't note that your comments were very kind at the beginning of this hearing, and yes, on February 28th, we are going to launch into a subcommittee hearing. And for those of you who might be surprised that there are even trees in Oklahoma, I can assure you that forestry is a crop to be planted, to be nurtured, to be harvested, to be replanted. So like all other good commodities that fall under this committee's jurisdiction, we're going to work aggressively on that at the subcommittee level. That said, I've listened with great interest and enthusiasm to my colleagues' comments and the comments of the panel. I would hope everyone on the panel would acknowledge that the biggest miracle of all is the fact that we are operating under the 2014 Farm Bill. And as the chairman, who was my loyal and dedicated wingman, and I hope to cover his back in this Farm Bill process, will attest to, there were times in that 2.5 years not everybody in this town thought we would have a farm bill and that we would wind up reverting to 38 and 49 and that the forces who didn't understand rural America would repeal those acts and we would have nothing. Think about where we would be today with nothing, and that's the direction we were headed. So it's an accomplishment. It is a miracle that we have this farm bill. And I know, gentlemen on the panel, that you appreciate this more than anyone, but the very basic concept in production agriculture, I guess, goes all the way back to my ag policy class 35 years ago at Oklahoma State, when Dr. Ray put so much effort into trying to explain the inelasticity of demand for food and fiber. And for some of my other colleagues, what that simply means in a rational way is either you have enough to eat or you don't. And if you don't have enough, you'll pay whatever it takes to get it. And if you have more than you need, you won't pay anything for the next. Fair layman's assessment, gentlemen, and that's what drives ag policy to be such a complicated thing compared to most other things in this building or in this town or in this legislative process. Then Chairman Peterson and I had a long series of discussions in 2009 and 2010 that whether it was in the beef cycle or in the grain cycles or the indirect consequences of renewable fuel standard, that we were building up productive capacity. Now the drought in my region from 11 through 14 and the drought that hammered my friends in the Midwest in 2012 distorted where we thought we would be, gave us a few more years of nice prices and in some cases record prices, but reality came crushing back to us. And that's what farm bills are all about, as the chairman alluded to earlier. We don't do farm bills for the good times, but we try to do farm bills to address the bad times. And that's where we are. That said, at least unlike Dr. Flinchbaugh and Chairman Roberts in 1996, we don't have to reinvent the wheel, or like Colin and myself and Chairman Conaway, reinvent the wheel again in 2014. We have something to work from. Not perfect. No legislative products are ever perfect, but at least we have something to work from. And my colleagues on this committee, pardon me for raving and ranting just a little bit, you're going to find out over the course of the next 18 months or 2 years how tough this is. the pressures that we will encounter from our friends on the right, who, as I like to say back home in my town meetings, don't want to spend any money on anybody for any reason, and some of our friends on the left who don't want to spend any money on rural America or the concept of modern, wondrous production agriculture in this country. We have to bridge that. We have to create a product that will meet the needs of our citizens, because after all, if those folks on the farm can't produce that food and fiber, that milk, then it's not going to be on the store, it's not going to be on the shelf, and then that strange concept called inelasticity of demand will kick in, and there will be a rumble. There will be a rumble. So with that, I look to the panel and say, not a perfect document, but it is a document, and I look forward to working with each and every one of you, and with our new secretary when confirmed, and with our chairman and ranking member, as we all together try to make sure that our fellow citizens have enough to eat, and that our friends on the farm have the capacity to provide that food and fiber, even if perhaps they don't always understand each other, or in some instances at the end of the food chain they don't have a clue where it came from. We're still doing important work here, no matter what the think tanks may think scattered around this town. And with that, Mr. Chairman, I feel better. I've got it off my chest. I yield back.
Well, I'm sure the audience appreciates the therapy. So, Mr. Desjardins, 5 minutes. Thank you, Mr. Chairman. Dr. Johansson, I don't know how much has been discussed today about trade, but probably the question I get most from my ag folks back in Tennessee, in addition to saving crop insurance, is what's going to happen with trade, because there were some great opportunities through the Trans-Pacific Partnership for our cattlemen, countries specifically like Japan or South Korea, and with the current administration not viewing those agreements favorably, what advice can you give us, and how can I reassure them that things are going to be okay in terms of trade with the new administration? What strategies do we need to be looking at?
Certainly that's a question that's on a lot of folks' minds. We did talk about trade a lot today. A lot of our baseline forecasts at USDA looking forward in terms of our price estimation and in terms of our production estimation for the major commodities have built into those assumptions that trade's going to continue on as is going forward. It didn't have TPP built into it, but it has our just general trends in trade that we've seen occurring over the recent history. And I would say in that forecast we still foresee a role for trade, an increasing role for trade, as I mentioned earlier, as U.S. producers continue to become more productive. We're going to need to find a place to sell those products, and selling those products overseas is something I'm pretty sure that we're going to continue to do going forward.
Okay, so right now what you're telling me is you see the status quo as being the policy until we're told otherwise?
I'm just saying for our forecast that I base a lot of my testimony on, that is based on the status quo, and I think certainly the new direction that we're going to get on trade, or the current direction that we've got right now, is going to continue to have to focus on trade for agriculture. I think in particular for this sector, it's important that we continue to trade, and I don't see that changing anytime soon. I don't know if folks on the other panelists want to take a bite at that one.
No, I just certainly agree that trade is absolutely essential to many sectors in U.S. agriculture. What happens in trade policy, what happens in trade arrangements with other countries matters a lot. Our own baseline likewise assumes a continuation of current policies going forward. We stand ready to look at what happens if there's alternatives.
Okay. And have you reached out with the new Ag Secretary, Perdue? Do we have a strategy for addressing trade with him, or is that not started yet?
Well, we're eagerly awaiting confirmation hearings, and we are looking forward to having the new secretary on board. And at that point in time, I'm sure that we would be more than happy to provide some more responses to comments to the record.
Any concerns with the proposed tax reform and the border adjustment tax in regards to trade? How will that affect our exporting?
I know there's been a lot of folks that have been studying that issue lately in Washington, and certainly I think the border adjustment idea is, has a lot of question marks around it in terms of what I've looked at in the past in terms of border adjustments, but we haven't conducted any analysis on that at this point in time at my office.
Just to add, there's questions about the WTO compatibility of some of the proposals that have been made, different arguments there. I don't pretend to know the answer, but clearly that's one you want to get a handle on before it goes forward.
Maybe a question I shouldn't ask in an open forum, but I've asked several people and haven't got an answer, and I'm sure it's simple. Are our exports taxed now? If we're sending beef to Japan, is it taxed on the way out? You make me feel better by...
Well, there's no different tax treatment for exported product than domestically consumed product today. So
Right.
it would be taxed the same way it be consumed domestically. Under the
Okay.
border adjustment, the exported products would not be taxed. Imported products would be taxed.
Okay, but they're currently being taxed
The same as
the same as tires or cars?
Yeah, same as
Okay.
any other beef.
All right, thank you. I yield back.
Gentleman yields back. Mr. Harrington, do you have another question for a minute?
Thank you, Mr. Chairman.
last for 1
Yes,
minute.
real quick, I won't editorialize on this round. If we were, has there ever been a cost-benefit analysis with respect to our investment in agriculture? And my understanding is with direct support for farmers, it's about 0.25% that relative to the federal budget that we invest in an ag safety net. Has anybody done the cost-benefit analysis on the cost to providing that and the return in national security? That is, to quantify the national security implications to not being able to feed your own people. Are you aware of any study, or have you yourself, Dr. Johansson, ever conducted such a study?
Well, I'll turn it over to these guys. They may have looked at this in the past. We certainly do a lot of cost-benefit analyses, and in terms of the projections of national security implications of not being able to feed ourselves, that has occurred in the past. I don't really have any idea of what the numbers are on that. I was certainly more familiar with research that has been done on the returns to providing investments in agriculture in terms of basic research and development. Generally speaking, in those types of analyses, you find for every dollar that's invested in research, you get a return between $10 and $20 in agriculture in benefits. And that spans a pretty large area, but I'll see if other folks might have other things to add.
Thanks for your time. All right. Well, gentlemen, thank you very much for being here today. You've clearly laid out for the committee and for Congress, and hopefully the other folks watching, the clear need for a safety net that is reliable, multi-year, that can be counted on by not only producers, but the lenders and implementers and others. We intend to get this done and done on time. Hadn't been done in 16 years to make that happen. The 14th Farm Bill, it couldn't make this argument that we needed it because it was harder to say in good times that you needed a safety net. That will not be the case over the next 2 years, and so my colleagues and I will have a little less difficulty, hopefully, explaining to our colleagues that why it's needed. The one group that is underrepresented in the conversation, though, are consumers, not just SNAP consumers, but all consumers. You can love the current Farm Bill or you can hate the current Farm Bill, but it delivers, along with, quite frankly, our producers, deliver the most abundant, safest, and affordable food supply in the developed world. And it's their hard work, it's their sweat equity, it's their risk-taking, and it is a reliance on a safety net that is there during hard times. And we are clearly in hard times based on the conversations you've made. So engaging the consumer so that they understand the deal. Everybody likes to get a deal. They get a deal every time they go to the grocery store. Every time they eat in a restaurant, they pay less for their food than anybody else in the world. And that's a result of hardworking farmers and ranchers across this country, and yes, reliance on this safety net. So engaging those consumers to help them understand why it's important to them, national security interest that my colleague just mentioned, and their own personal pocketbooks. that we have a strong production agriculture, and that by extension, rural America continues to prosper. So you have laid out the why very well this morning, and I appreciate each of you coming to join us this morning and whatever personal efforts you had to make to get here. I appreciate Dr. Kaufman swinging in from Omaha as well. So with that, under the rules of committee, the committee's record of today's hearing will remain open for 10 calendar days to receive additional material, supplemental written responses from the witnesses to any question posed by a member. This hearing of Committee on Agriculture is adjourned. Thank you all.